Joining us here at Post 9 this morning is Goldman Sachs chief economist, head of global investment research, Hatzius. It's great to have you back, Jan. Happy Friday.
Great to be on.
So a couple misses in a row, a couple months below 200K. We're in a period now of negative revisions. Is this ship turning?
Well, I think it is slowing towards a more sustainable pace of job growth. We're not going to see 200,000 or even 180,000 new jobs per month in a long-term sort of equilibrium situation, right? That's not the demographic trend. So there needs to be a gradual deceleration. And the fact that that deceleration is benign, I think, is also visible in indicators like jobless claims, which continue to be quite low. And the unemployment rate has been at 3.5% for well over a year at this point. So I would view this as a benign deceleration.
Should we, on wage growth, should we be looking at it with kinder eyes in light of work week shrinking or the productivity data this week?
Well, the wage number was an upside surprise. And I would say it's true that in 2023, while we've seen some deceleration, it's been very gradual deceleration. The average hourly earnings numbers have been the weakest of the major indicators of wages. So there's an aspect of convergence here that average hourly earnings have been a little firmer and the employment cost index, surprised on the downside. So these things are converging to some degree. But overall, I think wage growth is decelerating, probably needs to decelerate further for that to be consistent with 2% inflation in the long term.
How does this set us up for CPI next week and inflation readings beyond then, especially when you've seen things like gasoline prices and other commodity prices jump higher in recent weeks?
Well, the help on the disinflation from commodity prices, that is pretty clearly behind us. We'll probably get a bit of a boost from gasoline prices in coming months. The Fed is more focused on core inflation. Mm-hmm. Core inflation looks like it's going to be pretty soft, not just in the last report, but also in the next couple of reports. Two very tangible reasons: lower used car prices and more deceleration in rents. So it looks to me that the overall message from the inflation reports over the next couple of months is going to be pretty encouraging.
Jan, you will hear folks who have been anticipating a recession and maybe continue to see the risk of that by mid next year say that this path of job growth is also compatible with the deceleration towards zero. In other words, yep, this could be getting towards sustainable levels or not. What's going to make the difference there? We just got an Atlanta Fed real GDP tracking number of 3.9%. Who knows if that persists? But how does the job market feed into how fast this economy can go?
Well, it's certainly true that, of course, we don't know what's going to happen, and it's whatever we've seen in the past is compatible with a wide range of outcomes. That said, I think there's enough support to growth to keep it in positive territory. 3.9%, that's an outlier on the high side, I think. I don't think we'll be anywhere close to 3.9% in the third quarter. But there is support for the economy. Number one, real disposable personal income growth is pretty solid. The wage numbers are helping on that. The fact that price inflation has been slowing a lot more quickly than wage inflation is helpful for income. And I think the drag from higher interest rates, while I think there will still be a drag, I don't think it's going to be as large as it was, for example, in late 2022. And you can see that in the housing numbers, for example.